there's a reason. Like if you go to the biggest institutional investors in the world, they have about 50% of their assets in these alternative investment strategies. About 50% is in sort of 60-40 liquid markets, 50% in alternative investment strategies. And these are folks who could invest in literally any asset in the world. The reason why they put so much capital in those alternatives is because they generate such a high quality, they typically generate such a high quality, what we call risk adjusted return, which is the amount of return you're getting relative to the amount of volatility you're taking on an ongoing basis.
So the 60-40 liquid market that you referred to, that's 60% equities, 40% fixed income, roughly speaking. And then there's this whole world of alternatives that they're taking advantage of. I think a lot of people would be surprised to hear that it's potentially less risky.
Yeah, well, I think part of the reason why that is that these strategies are really centered on finding the best opportunities in the market. If you invest in, let's say, the S&P 500, right? There's a lot of risk in the S&P 500. There's lots of companies that could do well at certain times, but also could do poorly at other times, and have done poorly, right? Over the last, we've had 3 drawdowns of 30+% over the last 25 years, right, in the stock market. And what, for instance, in the hedge fund space, what those managers are looking to do is find opportunities that generate similar returns, but just have less risk. So buying assets or companies that are more cheaply priced, or using other instruments like hedges. I mean, in the hedge fund space, right? Hedges that can help protect in the event of downside risk in the market. And really, when you look at these strategies, in many ways, they're pretty boring to look at, because what they are that they generate pretty good returns when things are doing well, and they basically they preserve capital when things aren't doing well. And if you put those two things together, actually that generates a pretty good return over time with a lot less volatility. So it's more around the sort of, like, in many ways, almost boring, prudent risk management that is driving a lot of the outperformance on a return relative to risk basis.